So on that note, let's bring in Jeffrey Gundlach. He is the CEO, CIO, and co-founder of DoubleLine Capital. Joins us for our first Fed meeting of the year. Jeffrey, welcome back. What's your assessment of what you just heard?
Well, you're right that the money line was we're not cutting in March as a base case. And I think that that's going to be the case because we have an inflation model. I've talked about this after every Fed meeting. And we knew that inflation was going to come down. But for now, we think there's going to be a stall in the inflation rate coming down. And that will probably mean that the market isn't going to get the Goldilocks picture that it was euphoric about a couple of weeks ago. And that is that the Fed's cutting, it's going to come soon, it's going to be quickly. That's not going to happen. So I think risk assets got to a very high level of enthusiasm, not just stocks, but things like junk bonds, bank loans, very, very high prices relative to where we've been on average over the past couple, 3 years. In fact, a lot of these markets are kind of back to where we were at the beginning part of 2022. And so I think that Jay Powell did a really good job of being candid, I would say. There was a lot of less hand waving, I guess, and more statements. And the one on March was obviously the big one that tanked the stock market and got the bond market a little bit less enthusiastic, although the short end is still down significantly in yield. So on we go to the next meeting, and we'll see what happens. But the baseline here is the market can't expect a rate cut in the next 2 or 3 months.
Does March really matter when it comes down to it, as long as even the Fed chair admits they're likely to cut at some point this year? It's the trend that matters more than the date. Isn't that correct?
That is correct. But the market really, not very long ago, was pricing in March pretty heavily. And that led to very high valuations on a lot of risk markets. And the longer that the Fed stays at what is going to be about a 200 or 300 basis point real interest rate on Fed funds, there's risk to economic growth that's going to build as we move into this year. You know, everybody knows that the employment market on the headline establishment survey looks really good, but there were a lot of downward revisions in the last employment report, and the household survey isn't as strong. And there's also data that never gets reported to the extent it should be, which is unemployment data that's reported on a state level. The states do this too. And they have 51 states. I think they have DC in there as if it's its own state. And something like 85% or more of those 51 state reports have rising unemployment over the last 6 months. So there's a strange mathematical inconsistency that the unemployment rate stays at 3.7 on the national establishment survey, but over 85% of states report that unemployment is rising over the past 6 months. It almost doesn't seem possible. Now, the states that are not reporting rising unemployment are Wyoming, North Dakota, yes, Texas, I think Pennsylvania, but not California, not Illinois, not Florida, not New York. So I don't know, is unemployment really as low as we think? With continuing claims are rising, that's a leading indicator. Temporary employment is falling, that's a leading indicator. And the quits rate is now in every sector about the same as it was pre-pandemic. So this narrative of there's nobody quitting is just false. It's all the way back to where we were pre-pandemic. So I just think higher for longer is going to weaken the economy, and that's what you hear when March is. We have to see a big data change, which one should not expect. There's 2 data reports before March, but our inflation model isn't looking for further relaxation in some of the key inflation measures. I just want to say one more thing about inflation, and that is one reason to be optimistic past the next few months on inflation is that the PPI remains negative year over year. That's a leading indicator. And import and export prices, which are my favorite inflation measures because they're not adjusted in any way, those have been negative for a while now and remain negative year over year. So I think cuts are coming, but we're on a delay now, and I think that puts the market in a less euphoric position.
Well, I mean, if you look at the most important metrics on inflation, certainly to what we believe the Fed thinks is most important. Employment cost index is falling. Expectations are falling. PCE is going well in the right direction. So why not cut as soon as March? The worst thing that they can do is now take too long to cut, like they took too long to hike, isn't it?
I completely agree with you, Judge. I think that's the issue that the market's having in the last half hour or so, is there's risk that has been inserted into the marketplace relative to the Fed, because we were looking for 6 rate cuts based upon the pricing in the Treasury market using the WIRP function, 6 rate cuts here in 2024. And you better get started pretty soon if you're going to have 6. And now it looks like we're talking probably, I don't know, I'll just take a guess that the baseline right now is June on cutting rates. And do you really want to get aggressively cutting in the 5 months or 4 months leading up to the election, the presidential election? I don't know. I'm skeptical that the Fed is as political as many people assume that they are. A lot of people have been talking about that. The Fed's always political. I think it's somewhere in the mix, but I believe Jay Powell is not terribly political, and he's been doing a really good job over the past, I don't know, year now of communicating. It's the dual mandate, and now he's saying it's in balance and so forth, but he was crystal clear that the inflation rate has to stay at a level that resembles 2% or get near 2% and not go higher. And if that happens, there could be some real disappointments. The good news is I don't think it's going to go terribly much higher. And another reason I feel that way is the Bloomberg Commodity Index just remains in a protracted downtrend. The 200-day moving average just keeps dropping, and it's below its 200-day moving average. So that would not be a catalyst for inflation. The last thing I want to say about commodity prices is, with all of these tensions going on and saber rattling now with Iran and retaliation and already wars in Ukraine and Israel, it's interesting that the price of oil doesn't really go up. That would be indicative of a weak-ish global economy. We know that Europe is acting like it's in recession. We know that China hasn't been doing well lately. So it looks like the demand for commodities and oil is waning, and it's overwhelming even some very significant geopolitical tensions.
Are you still calling for a recession? Because I thought it was notable where Powell, a few moments ago, rather matter-of-factly said this is a good economy. And yesterday we had Ken Griffin on this network as well. He talked about Goldilocks, the potential of a soft or either no landing, and said the economy is, quote, pretty damn good right now. Are you calling for a recession still like you have been?
Yes, I am in 2024. Yes, I am. And I want to talk about experience in markets. And I've got a lot of it, being at this for over 40 years. And when I hear the word Goldilocks, I get nervous. Because when you hear people saying Goldilocks and everybody in the room nods their head in a north-south direction, and everyone says, yeah, it's Goldilocks, that means everything is priced to something resembling perfection, the Goldilocks outcome. When you're in Goldilocks, the problem is, I remember once in the year 1999, there was somebody that I worked with that was very aggressive in NASDAQ type of stocks, and he called the environment at the turn of 1999 into 2000 nirvana, investment nirvana, and I got a chill went down my spine. I said to myself, if this is nirvana, it means it can only get worse. It's like a AAA rated bond. They can only go in one direction. If you have nothing but AAA rated bonds and they're not guaranteed in any way, well, they can only get downgraded. They can't get upgraded. I feel that we're sort of priced for perfection when I hear Goldilocks language being bandied about. And today, Jay Powell took Goldilocks away, I think.
You said a little bit ago that risk assets are pretty extended, and you didn't limit that to equities. You mentioned parts of credit. So what would you do? And I should also preface that by saying that I got a text a few moments ago from somebody who's on my investment committee saying buy bonds, plain and simple. So what's your read on what the portfolio needs to look like given what Powell has just done, seemingly taking March off the table, though even non-committal? No one knows truly. It's 2 meetings, 2 months from now.
I think if you want to buy bonds, you should buy Treasury bonds, and you should buy Treasury bonds like 2 years, 3 years, 5 years, maybe out to 10 years. But I do think bonds remain very attractive with the inflation rate maybe stalling out in terms of its improvement, but likely to stay lower. We have a high real interest rate. But during the months of November and December and the first part of January, we had one of the best credit bond markets ever in terms of prices going up. Even the downtrodden started to rally in December. I'm talking about commercial mortgage-backed securities, which people would break out into hives if you talked about buying commercial mortgage-backed securities back last summer. Even those started to rally a lot. And really, I think in many parts of the credit market, things are overvalued because we've had this Goldilocks mentality. Spreads on investment-grade corporate bonds are in the top percentile of where they have been, which means they're the least attractive, in the bottom decile of attractiveness. Junk bonds, on average, are in 12th percentile. So they've been cheaper than this 88% of the time. And the Fed is not really going to bail out risk assets in the near term, per Jay Powell's own words. So the real interest rates on treasuries appeared attractive to me, particularly if the Fed is staying higher for longer and may, by that process, engineer a lower inflation rate than 2% by the end of this year, which would make bonds, treasury bonds, very attractive and lead to the Fed cutting interest rates. But unfortunately, that may be in the context of weaker economic growth and rising unemployment. So I like cash a lot now. I like defensive bonds. I like cash because I'm I feel like there's just as investment-grade corporate bonds are bottom decile of spread, I feel like risk is really in the top decile now in terms of valuation and problem. So I like cash because I think you're going to get better buying opportunities. You know, I've been talking about emerging market securities, stocks and bonds, but we remain underweight because we want to wait for the recession to come. And those areas have not been doing very well of late, thanks to China and thanks to slowing global economy. So I think you want cash to be able to get into that emerging market trade once the economy slows and perhaps goes into recession. I think globally, there are certainly many pockets of recession at present. But if we go into United States recession, I think we're going to see a buying opportunity, and you want cash for that. And, you know, you can buy the 2-year Treasury. That's sort of a cash surrogate. You don't have to roll it every 3 months. But on the shorter end, you know, you're still getting 5 1/4 on the 6-month bill, and that's probably fairly attractive. But I would want to have a little bit longer maturity just in case the rates start to fall and you have to reinvest at a lower level. But this is, for me, I'm in a defensive mode. When we talked in the November Fed meeting, I think it was November 1st, I talked about how I was pretty enthusiastic about things. But that has totally repriced since then. And so I'm sort of, the pendulum's on the other side for me at this moment.
It's been a different market. Bear with me, if you would, Jeffrey, for a moment. Let me just update our viewers as well. We are almost at the lows of the session, just slightly off. Dow's down about 280. The S&P 500's trading at 48.53. Remember, it was just a day ago where we got the first ever close above 4,900 as we headed into those mega cap earnings. We've given that up, obviously, with this move lower. S&P's down about 72 points. You know, Jeff, I thought it was also somewhat profound today and kind of underscored the shift in psyche, if you will, of where Powell and the Fed seem to be. Because it appeared to, I think, everybody throughout the beginning to middle stages of, let's say, this hiking regime that they've been on, that they needed to crack the labor market to get demand down and then ultimately to bring inflation down, to where now Powell underscored a number of times today, we want to keep the labor market strong. That is a change of focus, clearly, for the Fed. Now they don't think that they need to unravel the labor market, clearly, to get inflation to target, because I read you where the ECI is going, the cost index, of course, and where the PCE and expectations seem to be heading.
He also said, Scott, that the labor market is largely healed back to where it was pre-pandemic. Not all the way there, but largely there. And I think he's right about that on a lot of the data. And so it would be nice if the labor market didn't weaken, inflation would stay down at 2%. But like I said, 85+% of states say unemployment is up over the past 6 months. I just wonder about all of this. Are these numbers real? I don't know. But the JOLTS numbers used to get a lot of attention, the jobs openings. And people are starting to realize that that survey doesn't mean anything anymore, because the response rate to the JOLTS survey used to be 75%, and now it's something like 35%. So is it really comparable to where it was a while ago? Are people dropping out of the survey for I don't know, reasons? What reasons would they be? I don't know. But it's non-comparable. So today we got the ADP number, and I think this is what got the bond rally going today, and what hurt the stock market initially, was the ADP data was not great. Now, ADP data is notoriously non-correlated with the establishment survey that's coming out later this week, but it did seem to move the market because it was a noticeably weaker number. So we'll have to watch what happens there. I expect the unemployment rate is going to go up. I think the unemployment rate is going to end this year higher than the Fed's dot plot as of December. That's what I think is going to happen, and that's going to necessitate lower interest rates. And since we don't have those lower interest rates, even though the 2-year Treasury was down, at 4% with the Fed funds rate at 5 3/8, that's a pretty negative yield curve there from the Fed funds to the 2-year. It is not meaningless. This is going to have an impact, and the Fed staying higher for longer, I've talked about this for several months now, staying higher for longer is going to be bad for the banking system. And I noticed that we did have a little banking problem today, although I think it's isolated.
I do want to talk about that, and I'm glad you brought it up, because it's exactly where I wanted to go. The level of concern that you would have today around the regional banking system relative to commercial real estate. A couple of bad loans at New York Community Bank, and that stock is having one of its worst days, if not the worst day it's ever had, down more than 37%. This could obviously put pressure on the Fed potentially to move sooner rather than later. How do you see that?
It might. There's plenty of anecdotal evidence that particularly the urban office market in commercial real estate is a real debacle. I mean, there was loans underwritten on post-pandemic assumptions to a valuation on one building of $330 million, and it went into foreclosure and got sold out at $130 million. So that's a big haircut. And these things take time. In investing in the economy, everything, so I try to mentor the young people, everything takes longer than you expect. You can see that there's problems in commercial real estate, but it will take time for those things to go from a theoretical loss to a realized loss, and those things are going to be happening. So there's consequences to money printing, there's consequences to higher interest rates. They just happen in slow motion relative to what people have patience for. But that, I think, is going to be the story of 2024. Speaking
of money printing, I noticed many posts from you of late on social media about the deficit. Do you think markets are too complacent about that today? There was a moment a handful of months ago where it was sort of front and center. Rates had been moving higher on these concerns about funding the deficit and whether all of the supply was going to be able to be absorbed. And we sort of moved past that. As we said, we've hit new highs on the S&P heading into today. So what about that issue? Should it be of greater concern today than perhaps it is?
Yes, it should be, but like everything, it'll take forever. I don't think that the 2024 election will be about the deficit. I do think the 2028 presidential election will be about nothing but the deficit, because the interest expense is going straight up. We've added about $400–500 billion of interest expense per year already, and we have tons of bonds, like 17 trillion of Treasury bonds, rolling off in the next 36 months. And if we're higher for longer, every day we roll these things over, the interest expense is going up, and we're getting to the point where we can't deny it any longer. Medicare admits that it'll be broke in 2030. Using CBO assumptions, Social Security admits it'll be broke in 2032 using CBO assumptions, but those assumptions are overly optimistic. They assume no recession ever. They assume real GDP growth that resembles where we are right now. It assumes interest rates lower than what Treasury rates are today, and it assumes a deficit that's smaller than it is already today, even though we aren't in a recession officially. And so if you tweak those assumptions, it's more likely that Social Security and Medicare go bankrupt in the 2020s. than in the 2030s. And the last time I checked, we're midway through nearly 2020s. So this is going to be a really big issue. And higher for longer just brings it forward more quickly. And I think this is going to be the defining issue of the next 6 years.
You know, Powell has had the benefit of having, you know, unanimous votes inside that room. There haven't been any food fights, so to speak, about where policy is going to be. Do you think we start to get dissents, and does it matter at all?
It doesn't matter if there's dissents. I mean, it doesn't look good for the chairman, but ultimately it's Jay Powell's decision, I'm certain. And I think you will get dissents. I think you'll get dissents certainly by the May meeting if rates are where they are at that time and left unchanged. I think we'll start to see dissents. I noticed that there were some letters sent by a bunch of Congress people to the Federal Reserve people saying, you know, you need to cut rates now. I'm not sure what that's all about. Maybe they want to get reelected. I'm not sure, but I'm not sure what that's all about if everyone's crowing about this Goldilocks economy.
And lastly, before I let you go, let me ask you about the dollar, because it's another, you know, asset class, if you will, that you've spoken about with me on numerous occasions. You had what was a weak dollar you had expected to ultimately strengthen, which of course it did quite substantially. So how does that play work now relative to what your view is vis-a-vis what the Fed chair said today and what you think they may do?
It should sustain a relatively stable or stronger dollar because the market was looking for rate cuts, and they're not coming, at least not in a couple of months. So I do think when the recession comes, the dollar is going to be very different than it's been in past recessions. In past recessions, it would always get stronger. This time, I think it's going to get weaker because of the policy response to the recession. One thing I want to say, I've for a long time recommended India as an equity asset. The Indian economy is the strongest economy in the world. Their services PMI is over 60. Their manufacturing PMI is basically the most robust in the world. I think that investors should be using weakness if recession materializes and start to doubling up on the INDA, the Indian Equity ETF. I don't have a stake in it because I don't like to recommend things that would be in my funds. But I think INDA is a good investment for people looking to get equity exposure on weakness. It's my #1 recommendation for 2024.
All right. Well, that's a good way and a good place to leave this. Your insights are valuable. We count on them every Fed day. I really appreciate your time. We look forward to the next one, Jeffrey. Thank you.
All right, Scott. Good luck.
Yep, you as well. That's DoubleLine's Jeffrey Gundlach joining us exclusively as he does every Fed meeting. Right when the Fed chair finishes that news conference, you see Jeffrey Gundlach, and you will continue to do that.